Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The S&P is down by over 1%. A big part of this was the Bloomberg report overnight that we could potentially see severe trade restrictions if companies like Tokyo Electron and ASML continue to give China access to advanced semiconductor technology, and that whole situation is weighing on the chip stocks. Enda Curran, Bloomberg Global Economy Reporter, is joining us. Enda, can you walk us through the potential, what the Biden administration is thinking about?
So it's a pretty draconian next step. Essentially what the administration are talking about is making use of something called the Foreign Direct Product Rule. And in essence, that means that gives the US leverage over any kind of technology that includes any kind of US input or material or technology in any way. So it would be a big next step if they were to go down this route and try and put the clampers down on ASML and on Tokyo Electron, like you mentioned. Now, the thing about this is it raises questions in two ways. It's a delicate dance for the US in terms of how it approaches this with allies. It could be diplomatic tension between both Japan and the Netherlands. Companies in the middle of this already say that they've been hit hard enough. And then on the other side, it raises questions about, well, just how effective have the US policies been, because it was back towards late 2022 when the US announced these sweeping measures on chip technology export restrictions to China. Back then, it was expected to be a big deal, and well, clearly it's not necessarily having the impact that they wanted. So so it's a potential major step, but raises lots of questions about where this policy is going at the same time.
Realistically, what do you hear from, I guess, the industry about the ability to continue or to try to really make a change in where chips come from, how they're manufactured, the trade flows, onshoring, friendshoring? How realistic is that?
Well, we know there is some shifting of production manufacturing going on of not just the chip chain, but other production chains as well. We know, of course, that the big subsidies that the US have ruled out has attracted a lot of investment in the semiconductor space. So things are moving around, but there's still a lot of reliance, as you say, on some key kind of nodes, and that's and key companies like ASML and like in Taiwan and the like. But the other sort of feeling, I think, among the macroeconomic side of this is that people are kind of on pause now with investment and spending plans until they see where the US election goes in a few months. So, on the one hand, it could either be, broadly speaking, continuity with the current administration, or if it's a change of administration, it could be quite a different approach, maybe even more hawkish. That's what all the signals are. That's what our own interview with former President Trump signals. So there's a lot up in the air here, and I think this kind of potentially big step by the administration so late in the political cycle, I think, is giving people pauses just to ask questions about where is US policy towards China going in the near to medium term.
I mean, of course, it's always hard to understand the stock reaction with these kind of headlines because political hedging has not really worked. And also you have some of these stocks that have had a huge run up anyway. So we have to sort of take that with a grain of salt. Do we understand, though, what more trade restrictions will do to the global economy? I know that President Trump's team says that it's okay because we'll have lower taxes and more consumption, and it's going to be the other countries and companies that will pay for it, not the United States. What do you think? What's your research tell you?
I think people are starting to focus on this now, Alex, in a way that they weren't. I mean, the last few weeks, the political cycle in the US has changed a lot. And I think both in the US and globally now, people are saying, if there is a change of administration, what would it mean for the trade and flow of goods and capital and services? Obviously, US-China is at the center of it. It's red hot. But it's not just US-China. Former President Trump is talking about raising tariffs and driving hard bargains with all trading partners who have a deficit with the US. So it's just cementing this idea of heading for deeper protectionism, maybe deeper mercantilism, certainly less kind of cooperation on the world stage. And then how does that flow through to prices and people at home, consumers? It probably means more expensive production, so more expensive goods to buy, and that's the whole inflationary story. So I think there's a lot of uncertainty about where this is all going, but at the same time, people now are starting to focus hard on it in case of there is a change of administration in a few months in the US.
certainly having an impact on the market, that is for sure. Enda Curran, thank you so much for joining us. Enda Curran is a global economy reporter for Bloomberg News, joining us from Washington, D.C. And as you mentioned, Alix, really having an impact on the market, the S&P off 1%, but the NASDAQ off 2.3%. So that's where you're seeing it. I saw the Van Eck ETF, semiconductor ETF fund lost about 4% of its value today. So kind of across the board. But as you mentioned, Alix, we're coming off of those all-time highs. So the market was certainly looking for a little bit of a reason to pull back. And I think a little bit of political policy uncertainty that's kind of crept into the market. That would be the thing here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix Steele, alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance, and sometimes some politics, with our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries worldwide. It was the Business Week piece that has now been heard around the world. It was an incredible front page on what Trump would do with taxes, tariff, the Fed, and more. It's a real deep dive into Trumponomics in a way that I have not seen yet. It's actionable, it feels realistic, and it's really boiled down so we can really get a grasp on what a Trump 2.0 and Trumponomics actually means. And we can thank Brad Stone, the editor of Businessweek for Bloomberg, to kind of put all this together for us. He joins us now from San Francisco to California. Brad, I found this to be an extremely helpful piece because if you listen or you read excerpts from interviews with Trump, it's very difficult to get to concrete ideas, and you guys did an amazing job of doing that. How hard was it?
Yeah, thank you, Alix. Well, I mean, look, he wanted to talk. We'd actually put queries out to both campaigns. We heard first from former President Trump. You know, this is Business Week, so our mandate is business, obviously, economics, the world order. And we went there to interrogate him about an economic plan that many economists think is a bit contradictory. I mean, President Trump talks about lowering inflation. The agenda is, higher tariffs, less immigration, which potentially raises wages. He talks a lot about lowering interest rates and then bringing members of the business community into his administration. So this is a topic he wanted to talk about. To put it in context, we talked to him 2 days before the first presidential debate and about 2 weeks before the assassination attempt. But even then, I think, he is writing what he believes, at least, and his campaign believes, is a heightened sense of momentum.
So, Brad, there's a lot of areas here in terms of economics to explore. Talk about taxes. How does he feel about taxes these days? He certainly had some big tax legislation in his first term.
That's right. And one part of his plan is to extend the Trump tax cuts. Another part, which he told us, was to lower the corporate tax rate. He told the Business Roundtable that he wanted to bring it down to 20% from 21%, if for no other reason that he likes big, large numbers. But then he said he would even get it down to 15% if he could. The challenge here, of course, is that there's they don't delineate any way to pay for this, to make the numbers parcel out and do anything other than raise the federal deficit. And there is really, I think, a paucity of specifics here, which is one reason why proxies have kind of tried to fill the void with things like Project 2025, which then Trump really distanced himself from. But, I think, with the broad brushstrokes we got is Trump wants to lower taxes and extend his tax cuts.
What I also felt was very interesting is the myriad of views in relation to the tech industry. So on the one hand, okay, lower taxes, yay, tech industry. He seems to embrace crypto. Clearly, with J.D. Vance, there's sort of an embrace of VCs, but big tech is very complicated. And how did you parse through that?
There's some contradictions here, Alix. I mean, the first is, he's obviously very pro-American business, and yet he's turned on TikTok and believes that banning TikTok would only empower Mark Zuckerberg and Facebook. The second thing is, in the first term, he talked a lot about cryptocurrency and how it might engender fraud. He wasn't wrong about that, obviously, but now he's flipped on that as well. The bottom line here, and the way I interpret it, is that for Trump, it's all about personal relationships. And he went and talked a lot about Tim Cook and how smart he thought Tim Cook was, in large part because Tim Cook went to the White House to ask for relief from the first set of tariffs. He likes it when people come and pay their respects or at least visibly look to be on what he considers to be Team Trump. And so, in terms of crypto, and a lot of people in that community are now pro-Trump. And, in terms of TikTok, where he's very popular on TikTok, and of course, Jeff Yass, one of the backers of ByteDance, is a Trump supporter, you can kind of see why these contradictions are sort of bundled into his views on technology.
Tariffs. Certainly, it seems to be the topic, at least in the trading today. We've had both sides of the aisle talking about tariffs and tough tariff talk. Mr. Trump used tariffs quite, liberally in the first term. How's he thinking about tariffs these days?
It's interesting, Paul. I have not spent much time thinking about President William McKinley, the 25th president, even though he was from my former state of Ohio. And Trump brought him up repeatedly because, here's this 19th century president who, before the age of a federal income tax, was raising tariffs and bringing in money. And he said that McKinley is overlooked. Who knows what book club he's part of, but clearly they've been reading histories. And he wants to raise tariffs. He thinks tariffs are underrated. He's talking about a 10% across the board tariff. He's talking about raising the tariff on Chinese goods to 60% or even 100%. And, he says they're a great negotiating ploy. He tried that in the first term. And obviously then, a lot of U.S. companies, particularly tech companies, complained, and they were quite generous in their carve-outs. But this is a big part of Trumponomics, and most economists think that companies don't pay those tariffs. They turn around and pass them to customers in the form of higher prices. So we pressed him on it, and I think there are some unresolved contradictions and tensions there.
What's also interesting, I was reading a JP Morgan note about commodities and what the Trump administration would do to commodities. Obviously, that's my beat. But what they made the point is it really depends on the sequencing. So if you go to corporate taxes first, tariffs come later. Like the sequencing of how all of this works will really depend then on what the market reaction is. Did you get any sense of that?
No, in terms of how we would do it, I didn't. But
yeah.
I mean, one thing that impressed us or was impressed upon us is that in 2016, he was unprepared to win, and he surrounded himself with people maybe a bit impulsively, and he says that he would do it differently this time. That he knows who's loyal and who's not, and he's experienced and he knows everybody this time. And it just seemed to us that they were. That he is prepared to move quickly. In what order, I don't know, but particularly if he controls both houses in Congress, that they have an agenda that they're pretty much willing to implement at blitzkrieg speed.
Jamie Dimon as Secretary of Treasury, 30 seconds, Brad.
Yeah. What did he call him? An overrated globalist once. Look, he's courting the business community. Who knows if Dimon would do that, particularly considering how former members of Trump's administration often ended up being treated somewhat badly or breaking with him. But yeah, I mean, I think Trump wants to go and it's very important to him that business leaders like him. I mean, that comes through in the interview. And so he's doing his bit to court them as well.
Brad, thank you so much. Really, it was a great piece. It was so helpful, and it helps to bring perspective then to market reactions as well. Brad Stone, he is editor of Bloomberg Businessweek. So usually I have a routine. Yep. Like I have a routine on the way in. I'm like what I'm reading and how fast I have to read it to get read in. And this article just messed up everything.
It does. And the new Businessweek, it's a monthly now. But they're keeping the Businessweek name because it's got some brand value and it's cool. It is like thick and meaty.
Yeah.
And the first cover was Arnaud, talking about luxury. The second issue, Trump. So they're killing it here. So 12 times a year. Yeah.
So definitely check it out, guys. It's definitely worth it if you're interested in anything Trump related.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now for the market take is Sarah Ponczek, a financial advisor at UBS Private Wealth Management, and she's joining us from Boca Raton, Florida. Nice. Sarah, it's so fun to chat with you. So I understand we're seeing a decline in the NASDAQ. I understand the S&P is selling off. I also see that small caps are still holding their own here. Is this really about Trump? Is this really about trade restrictions, or is this the continued rotation?
Well, Alix, really quickly, I can tell you it's hotter here than it is in New York right now. So
right,
you can
whatever.
be happy sticking where you're at. But as for the rotation, look, yes, we've seen some political headlines come out. Yes, we are seeing semiconductors sell off, and we're seeing another tech sell off. But to your question, no, I don't think it's solely about headlines that, came out over the last 24 hours. Rather, what we're seeing is a continuation of this rotation that really caught steam, and really we saw fuel added to the fire last week after CPI surprised to the downside for the third straight month. So we're seeing, this changing of the guards within the markets. There's been talk for a while, how long can the Magnificent Seven or large cap tech or semiconductors continue to fuel the way higher? And it seems like last week we did see not only a bend, but a break with a really swift rotation. I mean, you just look at small caps over the last 5 days, up 12%. Meanwhile, the NASDAQ's flat. That just shows you the rotation, right there and then. So now the question becomes, all right, well, is this going to continue?
So what is the thought here, Sarah? Because I think, one of the concerns I'm sure you hear from your clients is that how healthy can it be for this stock market to be anchored by 6, 7, 8 names in terms of the performance year to date? That doesn't sound like a healthy market. How much of a risk is that for you?
Right. We do hear that question all the time. And to give you an idea of just, how consolidated the rally has been, if you look at the amount of companies that have outperformed the S&P 500 year to date on an individual basis, it's only 24%. So not even a quarter of companies within the index are outperforming the index, which just shows you how important a few companies have been to really dragging the gains higher. Now, is it a concern? Yes, there's always concern over narrowness in the markets, but at the same time, when we think about why there has been this narrowness in the markets, it's because these, large cap tech companies have been or become the epitome of quality. Investors have been flocking to quality names with high earnings growth over the past year and a half, let's say, and that's what's driven this narrowness in the market. So it hasn't been too large of a concern for us in particular, and we actually are still most preferred on technology, and we still think technology companies have a very important place in a portfolio. But yes, seeing a broadening out, seeing small caps perform, seeing some cyclical areas of the market like industrials start to catch up and perform better as well, that's definitely a well-taken sign. We are glad to see the broadening of the markets. And it's very possible that what you could see then is this, internal rotation of the markets where sure, we might see tech pull back a bit. That's only natural and healthy given the fact that, let's look at semiconductors, for example, this year. Semiconductors are up about 30% in 2024 alone and up over 50% over the last year. So it would be healthy for us to see a rotation in the markets, see the old guard start to, hold back a little bit, but it's possible we could see the market continue, if you look at the index level, continue to at least move sideways or move higher from here if we see other areas of the market that have underperformed start to outperform going forwards.
Yeah, that was kind of my question. It's like, is it a sell tech, buy small caps, which is sort of the narrative that we were starting to see yesterday? And if we get some impulse where small caps can't sustain this move that we've seen in the last 5 trading days, and tech still sells off, then it feels like we're in for a different kind of sell-off.
Right. And when we think about this rotation that we're seeing, there's really 4 factors that we feel as though need to happen in order for this rotation to continue in a healthy way for the market to continue to move higher. And what those 4 factors are, one, inflation needs to be contained, which per the CPI data we got last week looks like is possible. 2, the Federal Reserve needs to start cutting rates. We've been talking about it for a long time now, but we are as close as we have ever been, and we're finally seeing the whites of the eyes potentially of interest rate cuts, and the market's fully pricing in a cut starting in September and 2 this year, and then continuing into next year. The last 2 factors are probably more so where the risk is. So the third factor is that, economic growth needs to remain resilient here. Sure, we had great retail sales data this week, but if we see any signs that the economy is veering off, we could easily see investors, start to flock back again to those high quality growth companies. So there is a little bit of a risk there. And then the last one that I would say is that we need to see earnings growth converge between, these 7 companies and then the S&P 500 x these 7 companies. It might sound surprising because we have seen, fantastic stock, runs over the last year and a half, 2 years, but we're actually about to see in the second quarter, if you look at S&P earnings and you strip out those magnificent 7, the large 7 companies, this is actually going to be the first time since 2022 that we're going to see earnings per share growth for the rest of the S&P 500. So we need to see that continue, and we need to see those earnings catch up, with the earnings growth, continual double-digit earnings growth that we've seen from those 7 companies alone.
So, it feels like for this market, earnings are going to matter this season. It's not just the Fed, and the Fed's going to lift this market. Earnings have to come through. How are you guys thinking about this earnings season that we're just kind of in the early stages of?
Right. Earnings absolutely do have to come through. One, there's a couple things that we'll be paying attention to. If you look at the first quarter earnings season, the amount of companies that mentioned artificial intelligence and AI in their earnings calls was just through the roof. So are we going to continue to see them talking up AI? That'll certainly be an interesting trend, at least, to watch. From the numbers perspective for us, it's really seeing, okay, are we going to see EPS growth for cyclical sectors and say for consumer discretionaries start to move higher? If you look at where expectations currently are for the fourth quarter of this year, so not where we currently are, but future, looking out a little bit further into the year, the expectation is that we're going to see, year-over-year earnings growth for those 493 companies. So again, strip out those large 7 of about 11%. So double-digit earnings growth is the expectation for, the majority of S&P 500 companies, not including those, tech and, the large companies that have continued to do what they've continued to do best and make money and, produce earnings. So yes, starting this quarter, we need to see that that's actually going to be a reality and that we are going to see earnings growth come to fruition. Because like I said, we really haven't seen that since 2022.
Do you guys like the smalls right now?
We do. We see, look, if you're someone who believes that interest rates are going to come down, which we are, our economist's prediction is that we'll see a Fed rate cut in September, another one later in the year. We'll continue through the year. We're also, our chief investment office expects that 10-year treasury yields will probably end the year somewhere around 385. One of, the most pure ways to play a decline in interest rates is small caps, because those companies that have higher debt burdens are, at the forefront of the debt game, given that they just have more debt on their balance sheets. So yes, we do feel as though right now, if you don't have any small cap exposure in your portfolio, it could be time to add some as the tactical play. But, small caps in general have more risk than large caps. So making sure you can take on that risk. But yes, we do, see potential for small caps to outperform, from here on out.
All right, Sarah, thank you so much for joining us. Always great to catch up with you. Sarah Ponczek, financial advisor, UBS Private Wealth Management. Full disclosure, I am a client of UBS Private Wealth Management, Tony O.C.
Full disclosure, I'm a fan of Sarah Ponczek. So.
Yeah, I know. She's great. From Bloomberg News, Bloomberg Radio, TV back in the day, and now she's at UBS.
So we both have our biases there.
Yeah.
That's fair.
Going down in Boca Raton, Florida. So very good.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast. All right, 2024, it's an election year. We all know that. And that means an election is certain to be pivotal catalyst for markets and companies in terms of legislation, regulations, enforcement, and other government actions. Let's put some numbers on that. $25 billion of health-insured revenue, that's at risk as subsidies expire. 5 to 19%. Potential increase in required capital for large banks, 28% corporate tax rate possible if Democrats sweep. So there are just a million variables out there that will be impacted by this election. So what do? You go to Bloomberg Intelligence. They've got the definitive research report on this election, the two candidates, the two policies, and what it could mean for banks and all types of companies around this country. Nathan Dean joins us here. He's the mastermind of this report. 42 pages it is. Bloomberg Intelligence Senior Policy Analyst. Nathan, I don't know where to start here because you've got the Republican Party and the Democratic Party clearly have different priorities as it relates to economic policy, regulatory policy. Where did you start?
So I think what we did is we started with the report by looking at what are the key sectors to watch, and we really had 5 of them. The first one was investment banks. As you mentioned earlier, if President Biden wins, you could see somewhere between 7 to 10% increase in capital requirements. If President Trump wins, that could be off the table. We looked at electric vehicles. The tax credits for the electric vehicles could be at risk during our tax reform debate next year. Like you mentioned in terms of tax, global manufacturers. President Trump has called for a 15% corporate tax rate. And just a few minutes ago, Representative Steve Scalise said he's going to make the tax cuts for individuals permanent. So tax reform and the impact on manufacturing. And the other two were healthcare to the $25 billion subsidies. That's really for Centene and United Health. And then finally was big tech, because whether you get President Biden or President Trump, more likely than not, you're going to get a very skeptical Washington towards big tech, certainly both in Congress and also in the enforcement side.
Nathan, the question then becomes, what can he, and this has been the question throughout his 4 years also, what can he do on his own, and what would he need a Republican Congress for?
Yeah, so, I think one of the biggest questions we get from clients is, what does the executive order landscape look like if President Trump wins? And I'd say about 90% of the time, an executive order is a fancy way of the president picking up the phone and saying to his staff, I expect you to do X, Y, and Z. But there's a difference there. The difference is for trade, tariffs, and foreign relations, the power of the presidency is a lot more powerful when it comes to that. So when President Trump uses words like nasty, calling the European Union, as he did in this Businessweek interview that I recommend everybody read, that's something that investors have to pay attention to. Now, when it comes to tariffs, the president can certainly go out there and say, I want to do this, but then it's going to be up for Congress and the business community and so forth, but potentially try and influence the White House to either get to the appropriate amount or try, in some cases, stop it from even happening.
So are there certain industries that, I think about the healthcare industry. I'm trying to think about regulated industries, and healthcare is certainly one of them. And you mentioned the subsidies, but do the Republicans and the Democrats think differently about the economics of healthcare?
Yeah, it does. And this is really where the process comes into play, because that subsidies, that $25 billion subsidies, is Obamacare subsidies, and that requires an act of Congress. And I think you don't need to be a Washington expert to know that gridlock is going to continue no matter who wins the presidency. So look for subdued actions from Congress when it comes to healthcare. Now, the difference is on the regulatory side. On the regulatory side, and this is where you look at the FDA and a lot of the actions they've been doing, you can bypass Democratic opposition and just implement your own policies, but it takes time. Mm-hmm. And so I would say just general rule of thumb for a lot of the healthcare issues that are going on at the agencies, after President Trump, if he wins, were to input his new regulatory leadership, at that point, you probably have another 18-month to 24-month window for any regulatory change. So for the healthcare industry, there's a lot of time to prepare for any changes. You'll know exactly what's going to happen well before it does.
Going back to the EV point, it definitely feels like solar, EVs, stuff like hydrogen from the IRA, like those are the stuff maybe potentially on the chopping block, potentially, with a President Trump win. But then the Musk thing is weird, because President Musk, what does that mean? Elon Musk has definitely become a big supporter of President Trump, donating to super PACs, and I'm wondering if that relationship will change the calculus to how President Trump sees electric vehicles.
Absolutely. You hit it right on the head. And we even say this in the report. There's a difference between headline risk and reality. So if you look at the electric vehicles, you can look at statements that President Trump and other Republicans have said, saying they do not like these electric vehicle tax credits out there and so forth. But then you balance it with Elon Musk, and even taking it to a grander scale on the Inflation Reduction Act, a lot of the benefits of the IRA are going to GOP-led states. So what you have to do here is, A, take the statement, okay, if President Trump says, I want to do away with the electric vehicle tax credit, how am I going to do that? Most likely, I'll do that as part of tax reform and via the reconciliation process. which means I probably won't have any Democrats going aboard with me. So I need all Republicans on board. At that point, if Elon Musk starts whispering, saying, hey, we like these tax credits for the EV world, then that change may not even be a high priority anymore. So I would just say that for a lot of the statements, you have to remember short-term risk versus long-term risk. And as we see with every single election, politicians of both parties love to go out there and say, I'm going to do X, Y, and Z. But then when they get into power, it's X, Y, Z minus a whole bunch of other stuff because I'm going to be a little bit more moderate now.
Hey, Nathan, how about for our good friends on Wall Street, M&A bankers and lawyers? Under this administration, the regulator has been pretty tough, and it's been pretty tough to get big M&A deals approved. Presumably, that would be more Wall Street friendly, M&A friendly with a Republican administration?
It really depends on the leadership that President Trump, again, if he were to win, would put in place at the FTC and the DOJ. Because you have one side, you have the Republican business-friendly view, the stereotypical Republican business-friendly view. If you get somebody like Jamie Dimon, and I'm just picking on the banking execs, if you get somebody from Wall Street, like a Gary Cohn individual that was in his last administration, then you could just reasonably say that M&A activity will get a little bit earlier or a little bit easier. But if you get somebody that comes from the economic populist side of the party, for example, Senator Vance, the vice presidential candidate, spoke in favor of the FDIC chairwoman Lyman Khan and said that she was one of Biden's best picks. And so if President Trump comes out and picks an economic populist for the heads of the FTC and the DOJ, M&A may be very difficult for the next few years. It really just depends who's going to get that nod, and that would come right after the election or right after inauguration if President Trump wins.
Now, obviously, what we're seeing in the market today is a steep reaction to tech selling off, but also the news that potentially President Biden administration is looking for other ways to curb foreign technology chips making it into Chinese things. So ASML, Tokyo Electron getting hit. Are these kind of companies in this sector going to be hurt like no matter what? Like either way, both administrations are going to crack down even harder on China. And how do we think about that?
So the answer is at a high level, yes. So the Biden administration has already even put out a proposal on Treasury. The Treasury Department has put out a proposal limiting private equity investments into semiconductors, artificial intelligence, quantum computing in China. So being seen as tough on China is good politics, no matter who you are. But the one thing that we're seeing from statements from the White House, but whether it's Trump or Biden, is that there's always chances for flexibility down the line. Because the way this works is that the president goes out and makes a statement, and then it's up to his staff to actually implement it. And as you go through this implementation, you often see instances where the president dials back. Because look, whether it's President Biden or President Trump, they have to look Xi Jinping in the face and say, we're going to do this. So I would just say that, starting it right now, the answer would be yes. No matter who you are as president, it's going to be seen as difficult. But let's look at the geopolitical tensions as we get into 2025. And let's see if the president's stances changes any, because ultimately what we could face with in, say, 2026 could be dramatically different.
All right, Nathan Dean, thank you so much. We appreciate it. Nathan Dean, Senior Policy Analyst at Bloomberg Intelligence. If you have a Bloomberg terminal, BI Laws, LAWS, takes you to the dashboard that has all the policy research from Bloomberg Intelligence, and they got it neatly laid out there, and you can click on the election matrix, and they got all the election research that's been written by all the BI analysts across Bloomberg Intelligence, how different administrations would impact their individual industries. So it's a great place to see all that research in one place.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well, so check us out on YouTube. Go over there and search Bloomberg Podcast, and that's where you'll find us. I'm just looking at the chart of Tesla all over the place. I mean, the stock's flat year to date, but it's up 75% from an April 2024 low here. So it's just been all over the place. I think it reflects the uncertainty in the market as to ultimate demand for electric vehicles on a global scale. Tali Miller joins us. She's the Chief Business Officer at REE Automotive, joining us via Zoom from Tel Aviv, Israel. Tali, thanks so much for joining us. I wonder in your business, because your company is in this EV business, what's your view of kind of what we're seeing and maybe some waxing and waning in demand around the world for EVs. What's your view?
Hi, good morning, and thanks so much for having me. What we see as we are focused on the EV commercial market, and I can tell you that we see more and more demand driven on the one hand by fleet asking for electric trucks, as well as the infrastructure being ready steadily. So we do see a growing demand on our side.
So why is that? So why will the commercial vehicles and fleets be easier to move over than like Paul buying an EV?
Sure. So the commercial EV market has been growing, I would say, slower or started picking up slower than the passenger EV. But we've seen more and more demand recently, and it's mostly due to the fact that the fleets understand that there is a strong side on the total cost of ownership, so the overall unit economics that makes a lot of sense for them to transfer into EV. In addition to that, the infrastructure is being put in place, and therefore this combination makes it more attractive for them, and that's the reason we see this growing demand in the EV commercial space.
So, I mean, but I think one of the challenges, just certainly in the automotive and in personal use space, is cost and the relative high cost of EVs and the inability to bring those costs down and profitably build vehicles at a lower price point. Is that how do you view that issue overall, and how do you think that'll play out?
That's a very good point. And indeed, this is one of the elements that is key for our customers. They call it overall the total cost of ownership. So overall, it's not only the acquisition cost, but then it's what does it take when you use the vehicle. So commercial fleets are being used most of the day. So let's say 95% of the time, the vehicle is being used. And therefore, the fact that it's electric rather than internal combustion makes it more favorable overall on the TCO. This is the feedback that we get from our customers, fleet customers such as Penske and U-Haul, with which we work.
There's other ways to sort of also move away from fossil fuels, right? There's hydrogen, maybe hydrogen cars at some point, fuel cell batteries, biofuels, e-gasoline. Are you noticing a rise in any of those options when it comes to commercial fleets?
Overall, what we see from a REE perspective is we are really agnostic to power. The first trucks that we put on place are in the medium duty sector are electric trucks, and this is where we see a lot of demand right now. But eventually, we are completely agnostic, since our core technology, the core of what we're doing, the technology is can be applicable to any source of power.
Are you seeing different demand in different parts of the world? I know your company is in the U.S. They're in China and other parts of the world. It just feels like in the U.S. might be behind some other parts of the world in terms of consumer demand or just user demand.
Yeah, so overall, indeed, there is a difference between the different locations in the world. So we have started our activities in the U.S. market, and this is where we see a lot of demand right now. We have certified our vehicles in the beginning of the year. We're actually the first vehicle to have certified a full by-wire, and see a lot of demand for that. In Europe, there is demand, but for slightly different vehicles than the ones we see in the U.S. on the commercial space. And China is I would say a different market in this space. So we are currently focused on U.S. and Canada.
We talk a lot here about traditional car companies and then sort of the upstarts, right? I mean, Tesla's not an upstart, but Rivian, Lucid, etc. Volkswagen plowing about $5 billion into a tie-up with Rivian Automotive. What are your thoughts about that? They're going to jointly develop a battery-powered vehicle and software. It helps the German car maker get a boost to U.S. company technology, and Rivian gets a lifeline, basically. What are your thoughts from your perspective on this deal?
So maybe in a sentence, I think it's a brilliant deal for these two companies, but also this indicates the market about the readiness of legacy OEMs to integrate proven and superior technologies. So from a VW point of view, indeed, they integrate the technology, the software-defined vehicles, and for Rivian, it's great because they can tap into the supply chain of VW, and there together they can bring an attractive vehicle from a technology and cost standpoint. For the market, what it shows that legacy OEMs are ready to integrate now technologies, exterior technologies that are proven and that are superior into the core of what they're doing, and therefore it's very relevant for us at REE Automotive.
All right, Tali Miller, thank you so much for joining us. Tali Miller is the Chief Business Officer for REE Automotive. It's a publicly traded company on the NASDAQ. REE is the ticker. She joined us via Zoom from Tel Aviv, Israel, where the company is based here. But it just goes, we saw some news, just really over the last 6-9 months, the U.S. OEMs, auto companies, just dialing back their EV rollout, either timetable, volume targets, things like that. And they're basically saying that they don't see the demand, and that's kind of been the issue. And so is it price? Is it the fact that, you can't charge it as efficiently as you can, as a lot of people would like? What's really holding the demand back?
And interestingly enough, when Bloomberg reporters talked to President Trump and editors and they spoke with them, they asked about EVs. And President Trump said, I have no objection to the electric vehicle, the EV. I think it's great. And that's sort of in response to if President Joe Biden's done anything with respect to the economy. And then he says the cars don't go far enough. They're really expensive. They're also very heavy. And this is all in that great Bloomberg Businessweek piece. So it's hard to that's different. That's different than saying EVs stink. We got to go back to internal combustion engines. They don't go far enough. What does that mean?
Yeah. So it's just, it's kind of what I think a lot of people tell you, performance versus cost versus reliability versus preserving value in terms of the resale market. So there's a lot of issues out there. And, a lot of the bulls are still saying it's a bump in the road. We're still going to move towards electric.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.